My top 4 dividend stocks in the healthcare sector. Let's see what we got. So coming in at number 1, we got old reliable in Johnson & Johnson, one of the biggest pharmaceutical companies out there. And J&J is basically split up into 3 operating segments. Number 1, we got consumer sales, which makes up about 17% of the total revenues for J&J. And consumer sales is one of those segments that we can all pretty much understand. They got brands like Tylenol, Zyrtec, Neutrogena, and Listerine. Next, we got the pharmaceutical sales, which is more than half of the sales from Johnson & Johnson come from this segment, about $42 billion in 2019. And then lastly, we have the medical devices segment, which accounted for 32% of the sales for Johnson & Johnson. Now, to be honest, these last 2 operating segments, their pharmaceutical sales and their medical devices sales, is not really my strong suit, but the investment in Johnson & Johnson is more based off the fundamentals and the track record. And talking about track record, when it comes to dividends, Johnson & Johnson has been paying and increasing their dividend for 57 consecutive years. I believe that's the number 1 or the number 2 stock in my portfolio that has the longest streak of dividend increases. Now, as far as their dividend right now, they are paying $4.04 per share, which gives them an opening yield of around 2.8%, and that is higher than their 4-year dividend yield average. Now, as far as earnings for Johnson & Johnson, we do have the forecasted 4 quarters for J&J, and as you can see here, they're projected to do $7.73, and with their payout at $4.04, that gives them a payout ratio of 52%, which is not too bad. Now, as far as valuation, their 5-year average PE is at 21, and I think a good entry point for Johnson & Johnson right now would be at an 18 to 19 forward PE, putting the stock at around 138, 146, which is right in the range where it's trading at right now. And if we take a look at my position, I do own a few shares at around 126 average cost. I do think now is a pretty good time to add in a couple shares. However, I do want to point out that they got their earnings report coming up next week. So I think the play could potentially be to buy maybe 1 or 2 shares at least for my portfolio before the earnings call, and then see what happens after the report and maybe pick up a few more shares. Now, as far as their earnings growth for Johnson & Johnson, they are projected to grow just under 5% at 4.8 for the next 5 years per year, which is not too bad considering the size of Johnson & Johnson. Moving on, we got another big pharmaceutical name in Bristol-Myers. Now, with Bristol-Myers, they're not like Johnson & Johnson that has the consumer and medical side to their business. They're strictly just with medicine and different drugs. And here we can see the top drugs for Bristol-Myers, 3 of them coming from the acquisition of Celgene. And as you can see here, these 3 top drugs that they have now are part of their portfolio. Now, when it comes to these pharmaceutical companies, it's really tough to understand their business model, but one thing is for certain, you have to pay attention to their LOE, which is their length of exclusivity. Basically, how long do they have before the patents on the drugs go public, and then other companies could start copying the same medicines that Bristol-Myers has. Now, when it comes to drugs that are expiring soon, we do have 3 drugs that are expiring within the next 3 years, which all 3 combine for about $6.4 billion. But then also you have to keep into account the pipeline that Bristol-Myers has. Again, these are all drugs that I'm not really too familiar with, but from what I've read and what I've heard from analysts, these drugs do have good potential and generate good revenues for Bristol-Myers into the future. Now, as far as their dividend, they have been paying and increasing their dividend for 13 consecutive years, which is a pretty good track record thus far. Now, as far as their dividend right now, they are paying $1.80 per share, and at current prices, that gives you a starting yield of above 3%, which is higher than their 4-year dividend yield average. Now, moving on, we got the earnings per share projected for Bristol-Myers for the next 4 quarters, and they're projected to do really well. They're projected to do $6.26 for the next 4 quarters, and with their payout at $1.80, that gives them a very healthy payout ratio of under 30%. So there's definitely room to grow their dividend if they can continue to grow their earnings per share. Now, as far as valuation, their 2-year average PE is at around 13. Now, I'm using 2 years because if you go further out, the multiple on Bristol-Myers is actually in the high teens. So if we're looking at a good buying opportunity, I think if we're buying the stock at around a 12 to 13 forward PE, which is pretty much in the high 70s, low 80s range, I think you're getting a pretty good deal and a pretty good risk reward for getting into this stock. And the stock right now is trading at around 60, which I think is a lot of upside for this stock moving forward. Now, as far as Bristol-Myers in my portfolio, I was able to pick up some shares in the low 50s. I was able to build up a position of 15 shares with an average cost of 56. And currently right now it is about 2% of my portfolio, so I don't mind adding in a couple more shares while they're trading in the low or high 50s. Even in the 60s, I would still consider picking up a few shares to build out the position. Now, as far as their earnings growth for the next 5 years, they are projected to do 21% in earnings growth for the next 5 years, which is definitely really good. Most of it is coming from the Celgene acquisition, but still, that type of growth rate is going to grant them a higher multiple down the line, or at least that's my thought process. Moving on, we got the healthcare services provider in CVS Health, and when it comes to CVS Health, I'm looking at three things. Number one being the health hubs and the minute clinics in their stores. I really do want CVS to continue opening these health hubs in their stores across the nation. Number two is going to be the Aetna acquisition that they acquired in November in 2018. And I think they need to really find the synergy, which they do have with health insurance, and try to implement that to their business as efficient as possible. And lastly, their CVS brand. I would like to see CVS continue to modernize their stores, their apps, and as well as their branding when it comes to younger and older people. Now, I do know that the biggest threat to CVS Health is going to be Amazon and the threat of them entering the pharmacy space. However, my take is that people are more likely than not going to want to go to the actual pharmacy store to pick up their prescriptions, as well as talk to an actual pharmacist, especially if they have any questions or concerns. Now, CVS needs to make that process as simple and as convenient as possible so people can continue to go to their pharmacies to pick up their prescriptions. And I do see that happening with their health hubs, their minute clinics, and their apps. As long as they can continue to be modern, simple, and convenient, I do think people are still going to be going to the pharmacy to pick up their prescriptions. Now, one last thing I do want to point out for CVS is their operating segments. And I have the revenues for 2019 versus their revenues in 2018. And I want to point out in their pharmacy segment, in 2018, their sales from this segment accounted for almost 70% of their total revenues. And then after the Aetna acquisition, it went down to 55%. Now, I'm not saying that the pharmacy segment went down in revenue, it actually increased year over year. But the important thing is that now their healthcare benefit segment with the acquisition of Aetna went from 5% of their total sales to now 27% of their total sales. And you can also see this in their operating income results as well. Now, as far as dividends, currently right now, they don't have a dividend streak of dividend increases, but up until 2018, they had grown and increased their dividend for 14 consecutive years, but now they just halted their dividend at that $2 a share, mostly because of the Aetna acquisition and trying to improve their balance sheet. But still, they do have a really good track record of at least paying their dividend consistently. Now, talking about their dividends right now, they are still paying that $2 per share. And if you were to enter into the stock right now at these prices, you would get a yield of above 3% on the stock, which is definitely higher than their 4-year dividend yield average. Now, as far as CVS's earnings coming up for the next 4 quarters, they are projected to do about $7.08 for the next 4 quarters. And with their payout at around $2, that gives them a very healthy payout ratio of 28%. Now, that payout ratio is really good for them to grow their dividend, but I don't see them increasing their dividend until they can improve their balance sheet just a little bit more, just to be on the safe side, which is completely fine with me. Now, in regards to valuation, their 5-year average PE sits at around 16, and I think a good buying opportunity for this stock with a good balance of risk reward would be an 11 to 12 forward PE, which would put this stock in the low 80s or in the high 70s. And currently the stock right now is trading in the 60s. So pretty much any way you look at this stock, it's pretty much super cheap. However, it is cheap for a reason. Again, they have the huge debt that they acquired when they got Aetna in the acquisition. I think their debt went from around $20 billion to $65 billion in debt, which is something that's definitely concerning. And they still need to execute in their health hubs and minute clinics around their CVS stores. So there's definitely some risk to this stock, but I think if you're buying it at a 9, at an 8 forward PE, I think that minimizes your risk substantially and gives you a very good opportunity for some good long-term gains down the road, as well as a nice dividend to go along with it. Now, as far as my position in CVS, I do own quite a bit of shares. I own 33 shares at about $63 cost per share, and that's really close to 5% of my portfolio. So at these current prices, as much as I would like to buy, I'm probably not going to buy just so the position won't be so big in my portfolio. And as far as their earnings growth, they are projected to grow at about 6% for the next 5 years. However, if CVS is able to execute at a really high level, I do think that maybe their earnings growth for the next 5 years could be a little bit higher, but I do think 6% is pretty fair. And our last health stock on the list, we got UnitedHealth. And UnitedHealth basically has two segments. They have their UnitedHealth Care segment and their Optum segment. Now, basically, UnitedHealth Care is the benefits that they provide to employers that then provide to their employees. And then their Optum segment is the marketplace health insurance that you would get if you weren't being insured through your employer. Now, the UnitedHealth Care segment accounts for 63% of their revenues and 37% for the Optum group. Now, as far as their dividend, they have been paying and increasing their dividends for 11 consecutive years, which is a pretty good track record. Now, as far as their dividend right now, they are paying $5 a share with an opening yield at current prices of 1.7%, which is a little bit higher, not by much, but it is higher than their 4-year dividend yield average. Now, when it comes to valuation, I think this is a bright spot for UnitedHealth, at least right now. They are projected to do about $16.88 per share. And with their payout at $5 per share, you do have a really nice payout ratio at 30%. A payout ratio that they can continue to pay and grow their dividend moving forward. Now, back to valuation, their 5-year average price to earnings multiple is at around the 20, and I think a really good buying opportunity for this stock would be at a 17 to 18 forward PE, which would put them at the 287 to 304 price range. Now, as far as UnitedHealth and my portfolio, I don't currently own any shares, but if you notice, the price is right in line with what I think would be a good opening start for UnitedHealth. And plus, their earnings growth for the next 5 years is double digits at around 12.5%, which is a really strong growth rate for UnitedHealth. So those are pretty much the 4 healthcare stocks that I like. We talked about Johnson & Johnson, Bristol-Myers, CVS, and UnitedHealth. Hopefully the video was helpful, and thank you so much for watching.